So you've found yourself in the fortunate position of having a little bit of spare cash each month or come into a sum of money. And one of the most common questions I'll come across as an advisor is, should I overpay the mortgage with this extra cash? Or perhaps should I invest that? First off, this is a great position to be in, having that surplus of cash.
I feel so alive!
But because you're a responsible adult and all of that good stuff, you start to get this nagging feeling that you should be doing something productive with it.
Boring!
In today's video, I'm going to talk about how to approach this question so that you can make the decision that's right for you. Hi, my name is Andrew. I am a chartered financial planner advising clients in the UK. So if you're new to the channel and like this type of content, tap subscribe for plenty more to come in future. There are two ways of approaching this question. The first is treating it as a maths problem.
I have a pocket protector.
As you will no doubt know, the monthly payment that you make towards a repayment mortgage is made up of two parts. Firstly, a payment towards the capital balance that you owe, and secondly, the interest charge that the bank applies for you borrowing the money from them. And if you choose to overpay the mortgage, you reduce the balance that you owe, therefore reducing the interest that you'll pay. And not only does that mean that you will pay less interest over the term of the mortgage, but you can actually reduce the time it takes to repay the balance. Money Saving Expert offer a great calculator to save you from having to crunch your own numbers on this, which I'll link to in the description. And as a quick example, if you had a £130,000 mortgage balance with a term of 25 years at a 4% interest rate, you'd normally be making payments of £690 a month. But if you chose to overpay by £100 a month, you'd save yourself £16,570 in interest and bring the term of the mortgage down by around 5 years. You can also model a one-off lump sum overpayment with the calculator, and using that same mortgage I've described there, if you paid off a £20,000 overpayment as a lump sum at the outset, over that 25-year term, you'd save over £28,000 in interest and have the mortgage paid off 5 years and 10 months sooner than you would have done. However, what rate of return could you be getting if instead you invested that money? Which from a maths perspective then makes the question, what is the expected annual rate of return on my invested money versus the interest rate that I'm paying on my mortgage? Since 2008, we have lived through a period of abnormally low interest rates by historical standards, right up until about 2022. And with hindsight, we can now say that during that 15 years or so, it would have been to your advantage to be invested rather than paying down the mortgage, of course, with hindsight. There's no real debate in this matter. The interest rates on mortgages during that period were about 2 to 3%, and some people will have had deals that were next to zero. Meanwhile, during that same time frame, you could have potentially had investment returns that averaged out in the double digits. And yes, it makes some assumptions about how you would have invested. I've assumed here that you would have bought a basket of the world's companies and pretty much tracked an index. I've used the MSCI World and the S&P 500 as examples of indexes here, but that you bought a broad basket of companies, you didn't individually pick shares, and very importantly, that you stuck with this through that full time frame. More on that point later. But this is backward looking, and going forward, you would need to make an assumption about what your expected rate of return on your investments will be. And nobody, absolutely nobody, can tell you what that will be. There are no guarantees. As a financial planner, all we can do when we are planning with our clients is look at long-term trends and evidence to help guide us. And based on 100 years of market data, we can say that typically a basket of owning businesses, company shares, will deliver about a 10 to 12% annualized return on average, of course with some significant ups and downs along the way. And with this in mind, even with mortgage rates at 4 to 6% in 2024, you might say that on average, typically it weights in favour of investing rather than paying down this debt. But let me introduce a few caveats on the maths here. If you're in the UK and on a fixed term or some tracker mortgage deals, you will have to look at the terms of your mortgage to check whether there are any penalties for overpayment. Typically, whilst you're in a fixed deal, lenders will allow you to make 10% overpayments, but do check the terms before you go making significant overpayments, as you may be penalised. Secondly, time is a hugely important factor in these calculations. You might be on a 4% interest rate with your mortgage right now, but in the UK we tend to have 2 to 5 year fixed deals, which means you'll be remortgaging it at some point. Interest rates could have changed, deals could be different, and you might be paying more interest or less interest at that point. So you won't really know over a longer time period, like 20, 30 years, exactly what interest you are going to save. And equally on the investment side, you really do need longer periods of time to get closer to the average returns that we've talked about. If you invest for a 12-month period, the range of returns is huge. You could be up 30, 40% and equally down by similar amounts. So in a long-term trend, you can talk about average returns and probability, but over a shorter time frame, investment returns are unpredictable. On the investing side, also remember to factor in things like taxation or the cost of investing. I've just shown rates of return here based on indexes, but you might need to take into account things like a platform provider cost or potentially the cost of advice. And if you invest outside of ISAs or pension, there might be a tax drag for dividends, interest, or capital gains tax that you might want to factor in and drag down your returns by maybe 1% or so to adjust for this. Most people will be covered by ISA allowances, and if you are willing to defer some access and go towards pension, it could be even better in terms of the outcome, particularly for higher rate taxpayers under current rules. So if it were the maths that was solely deciding this question, it would be investing that tends to win out in the majority of cases. But we are not unemotional, completely rational machines that operate solely on numbers. To get the rates of return over the last 15 years or so that I highlighted in this video, that would have meant you would have had to sit out multiple falls in the market. And I'm not just talking about the obvious ones like 2020 where the market dipped significantly for some reason. I'm talking about multiple declines. Every year on average, the S&P 500, the basket of US shares, it declines, the intra-year decline that is, by about 14% on average. And that's just an average. Swings of 30-40% are not uncommon when you're invested in a basket of shares. And it's these temporary declines that test even the most seasoned of investors. Most UK investors know that they won't stomach these downturns in the market, that it would shake them out of the funds, they'd have worries, sleepless nights, in which case they choose to dampen that volatility by investing in funds that have other assets, a mixture of bonds and property and other things, which is fine, it's sensible for a lot of people in normal investing circumstances. But when you are talking about investing versus overpaying the mortgage, well, as soon as you start to dampen the volatility, you trade off the return, and you start to shrink that gap, that benefit of investing over paying the mortgage down. Loss aversion, FOMO, greed, fear in general, and a lot of other hardwired biases make investing much more complex than it should be due to us being human. And my final point on this more human aspect, one that I think goes underappreciated when people argue solely on the numbers basis, is the emotional, psychological benefits that come with being debt-free. You can't really put into words that peace of mind that comes from owning your home and not having to think about a mortgage. It's just something at the back of your brain that feels good, and it could be the catalyst that allows you to go on and do other things in life that drastically improve your finances in any event. That comfort of not worrying about the risk of losing your home, although it may be a small risk, it's there and it's in your mind. Once that's taken away, People tend to feel more comfortable taking a new career, starting a business, and doing something that could blow the other maths out of the water. So, is there a right answer with any of this? No. As always, finance and humans, it isn't. And don't shoot the messenger, that's just the way it is. But hopefully, these points are giving you something to think about, and you can probably start to get a feel for the math says investing with the right time frame, it will likely go in your favour. But you need to consider whether you have the patience and stomach for what comes with investing in order to get that gap and benefit over saving on mortgage interest. It's easier said than done. Would getting rid of the mortgage sooner, being debt free, and the peace of mind that comes with that be of more value to you in the long run? I do strongly believe that this isn't just a numbers question. And before you consider any of this, make sure you are on solid financial ground generally, with a good cash reserve or emergency fund, and you've got your life and illness insurances in place. Make sure you are set up before you start thinking about overpayments or extra investing. Do let me know in the comments your thoughts on the mortgage repayment issue versus investing, whether you've had any specific personal experiences on that front. If you're looking for advice in the UK, feel free to drop me a line. As always, thank you for watching, and I hope to see you for a future video.